According to recent statistics, retail bankruptcies are up 61%. Furthermore, U.S. store closures have increased by 77% in the last year, according to a new report released by Retail Dive in collaboration with credit reporting agency Credit Risk Monitor, which identifies several retailers that are most at risk of bankruptcy in the final months of 2023 or have recently filed for Chapter 11 protection and are about to close their doors for good. Americans will be alarmed to see dark storefronts and product shortages of hundreds of items around the holidays as more and more businesses close sites and cease operations in numerous parts of the nation. This tendency will only accelerate in the coming months, irreversibly altering our retail scene. That's what we're about to reveal in this video, so watch to the end and see whether your favorite retailer is going out of business in 2023. Hello, and welcome back to Serious Coinage. Make sure you watch until the end of the video. Number 1 might surprise you. Without further ado, here are 7 retailers on the brink of collapse. 7. Big Lots. This year has been particularly difficult for Big Lots. The bargain store recorded dismal sales performance for many quarters in a row, with double-digit sales reductions in the last 2 quarters. According to the most recent statistics, the company's revenues plunged another 15% in August, exacerbating its liquidity problems and prompting officials to implement further cost-cutting efforts. According to CEO Bruce Thorne, inflation is especially harsh on low-income customers, who are the brand's major client base. However, Big Lots issues are not new. According to Matthew Debish, CEO of the America's Nation at CreditSave, their income, earnings before tax, retained profit, total assets, and net value have all decreased in recent years. At the same time, their liabilities have grown significantly. A disastrous mix that is dragging the corporation closer to insolvency. According to Credit Risk Monitor experts, the store is in a grave financial situation, having lost 71% of its market value since October 2023, and it may go out of business by the end of the year. 6. Kohls. Kohls is the iconic department store, argues that the middle-class squeeze is the primary cause for their retail business's demise. However, experts believe that the chain's difficulties are entirely of its own doing. Following a 6.6% reduction in sales and a $302 million loss, global data analyst Neil Saunders believes Kohls' poor performance is mostly due to the company's dismal lack of standards and operational control. Another analyst expressed concern that Kohls excessively relies on its collaborations with other stores. It has long depended on the brand equity of other retailers, such as Amazon and Sephora, to generate traffic and sales, which is not a sustainable growth strategy. Insider Intelligence senior analyst Zach Stambor stated in a recent note, "The firm has had a difficult few years, defined by declining sales and an assault of investor attacks condemning the company's performance and leadership. But now Kohls is struggling with a new CEO, a bleak economic prognosis, and a 71% likelihood of bankruptcy." Stambor went on to explain that righting Kohls' ship would be difficult. 5. The Container Store. The Container Store has had its ups and downs throughout the years. Sales decreased by over 28% in the immediate aftermath of the epidemic in the United States, but by December 2020, when stimulus money began to enter the system and customers were ready to spend their dollars, the firm witnessed a 20.5% sales increase, which grew to 30.4% in early 2021. Unfortunately for the home goods business, the days of customers freely spending money on home supplies, renovating, and arranging their rooms are long gone. Sales fell by 21% in the first quarter of 2023, which CEO Satish Malhotra blamed on the tough economic climate. The company then announced major layoffs to reduce expenses and recover its financial sheet. Malhotra even took a 10% salary reduction to assist in covering staff increases and severance compensation. On top of that, the company's stock has dropped 56% in the last year. As a result, the Credit Risk Monitor estimates a high likelihood on the firm going bankrupt in 2023. Have a subject or company you'd like to see us cover? Leave it down in the comments section below. If chosen, we'll pin ya. 4. Kirklands Home. Kirklands, a home decor and furnishings business, may not survive the recession, according to retail experts. During economic downturns, the durable goods industry often suffers significant declines in demand and production, which might push the struggling firm over the brink in the coming months. The business has 360 sites in the United States. However, sales are now unsatisfactory at the majority of them. Since 2022, the company's overall revenue has decreased by about $100 million. Meanwhile, gross profit margins have fallen from 32.81% to 2.31%. To make matters worse, Kirkland's is cash-strapped. Cash levels have fallen from $80.16 million to $25 million in the last several quarters. The brand is blowing through cash in the first half of 2023 in anticipation of the great Christmas retail season that may not occur this year. The corporation often depends on the Christmas season and year-end revenues to boost cash flow for the next year. However, the monetary reduction this year is still significant. It provides minimal security and flexibility to the organization during times of instability. Seeking Alpha analysts assigned a sell rating to the retailer's stock. Given that Kirkland is in debt for $35 million, it will need to issue additional debt at higher interest rates to remain afloat in the coming months. But only if banks who are tightening their lending requirements agree to give additional money to a bankrupt firm. Unfortunately, given the possibility of more losses and the significant likelihood of debt default, it is improbable. It's no surprise that Kirkland's is also on the bankruptcy watch list for the fourth quarter. 3. 99 cents only. In the most recent quarter, 99 cents only retailers reported large losses. Sales and margins have continued to fall. For the quarter, the firm generated revenues of around $480 million. This is a 3.8% decrease year over year. The company also reported a $27 million loss, with gross margins falling by 5%. The dismal performance prompted Moody's to downgrade the regional discounts corporate credit rating, suggesting a worsening default risk and a larger likelihood of bankruptcy. The downgrade reflects the company's much lower than expected operational performance, which is causing liquidity constraints as we estimate free cash flow to continue negative. Mickey Chatter, Moody's vice president, said in a statement. Furthermore, the cheap retailer is losing ground to rivals such as Dollar General and Dollar Tree. Furthermore, bargain grocers are gaining market share, and many 99 cents only retailers seem less appealing to both investors and customers. 2. Rent the Runway. Rent the Runway, an apparel company, has been a sensation in recent years for renting high-fashion goods for regular ladies who want to keep up with continuously developing trends without breaking the budget or duplicating their ensembles. The company became a major success, reaching more than 11 million customers at its height, with over 800 brand agreements, sizes ranging from 0 to 22, and 3 primary subscription levels. And conditions have deteriorated dramatically in recent years. In 2022, its active subscriber base decreased by over 60%, and the corporation lost $171 million that year. The retailer's situation has not improved since then. In reality, Rent the Runway recently revealed a reorganization plan that included the layoff of 24% of corporate personnel. Meanwhile, the subscriber base dropped to 124,000 active users, and the stock dropped by 90%. As a result of these factors, credit risk monitor experts anticipate the firm will fail before 2024. If you've made it this far, make sure to like and subscribe to stay up to date on the world of economics. Now, back to the video. 1. Petco. Pet supply shop business Petco saw a surge in demand during the outbreak. The pet retailer's yearly sales increased during that time, and its stock price almost doubled. However, once the economy recovered, Americans began to spend their money on other products and services, and the brand suffered significant losses. According to financial experts, Petco was a highly leveraged investment. But without consistent sales growth and admitting to falling foot traffic, investors realized that its stock was no longer worth retaining, and shares dropped by 24% in a single week in August. Over the previous year, its market value has dropped by 65%. The firm is also saddled with a massive debt burden, which now stands at $3.03 billion. According to Retail Dive, Petco is now on the bankruptcy watch list due to its inability to improve cash flow and profitability. The corporation is in significant danger of defaulting on a nearly $800 million loan payment due this quarter. If it fails to pay its financial commitments, shareholders will pressure the company to develop a debt restructuring plan and file for Chapter 11 bankruptcy. Which one surprised you the most? Leave a comment in the comments section down below. As always, thank you for watching, and don't forget to hit the notification bell and subscribe for more. We'll see you in the next one.